18 hours ago, Fortune ran a headline capturing the most critical phrase in global finance this week. It boils down to a simple plea from Tokyo. Please, can you bring this money home? These 11 words reflect exactly what portfolio managers in Japan are hearing from clients, regulators, and their own calculations as they examine their U.S. Treasury holdings against the 20-year Japanese government bond yield at 3.555%. After decades of Japanese institutional capital flowing into U.S. Treasuries due to near zero domestic yields, a structural reversal that was once theoretical has now become reality. Japanese investors sold a net 4.67 trillion yen, roughly $29.6 billion in U.S. government, agency, and municipal bonds during the first quarter of 2026. This marked the largest quarterly sell-off in nearly 4 years. Analysis from Guru Focus, published 20 hours ago, indicates that the monthly pace of selling nearly quadrupled between January and March. Crypto Briefings confirms that if this selling trend continues at the same rate, annual outflows could surpass $100 billion, representing a significant structural shift in U.S. debt demand amid already elevated supply caused by persistent federal deficits. TD Economics, in its March 31st, 2026 report titled, What Happens in Japan May Not Stay in Japan, quantified the U.S. yield impact. Japanese reductions in Treasury investments could drive 10-year U.S. yields higher by 20 to 50 basis points in the medium term. A 50-point increase from the current level of 4.44% would bring yields to approximately 4.94%, nearing the psychologically significant 5% mark last reached in 2007. The Treasury Department has already tested this threshold, selling $25 billion of 30-year bonds at 5% yield for the first time since 2007. Mark Malik, Chief Investment Officer at Siebert Financial, explained that despite the Federal Reserve cutting the benchmark rate by 175 basis points since mid-2024, the 10-year Treasury yield has fallen by only 35 points, while the 30-year yield reached 5%. Before this, no 30-year Treasury exceeded 4.75%. This contrasts sharply with mid-February, just before the Iran war, when a Treasury offering saw record demand in 30-year auctions. The trajectory is clear: unprecedented February demand, a 5% yield 6 weeks later, and Japanese selling accelerating fourfold in a single quarter. This development is a red alert for Americans with 401ks, IRAs, pensions, money market funds, or 60-40 portfolios relying on U.S. Treasuries as a safe, stable component. The connection operates through 5 channels. The first channel is direct bond fund exposure. U.S. retirement accounts collectively hold around $11 trillion in bond mutual funds and fixed income ETFs, which primarily invest in treasuries. As yields rise, bond prices fall. A 10-year Treasury bought at 2.5% 3 years ago now trades at a discount compared to new 4.44% bonds. Bond funds generally do not hold bonds to maturity, rolling portfolios to buy new bonds and sell older ones at market prices. Rising yields caused by Japanese selling force higher Treasury terms, directly lowering the market value of bonds held in retirement accounts. The second channel is the money market fund link. Money market funds, holding treasuries and high-quality short-term debt, rely on stable net asset values. Disruptions in Treasury demand can spike short-term yields, creating mark-to-market volatility, similar to March 2020 scenario when market liquidity froze. For 60 million Americans holding emergency or near-retirement cash and money market funds, stability depends on Treasury demand, which the Japanese sell-off is beginning to unsettle. The third channel affects pension fund liability management. Defined benefit plans, covering 35 million private and 15 million public sector workers, rely on long-duration treasuries to match pension obligations. Rising yields reduce the present value of future liabilities, initially improving funding ratios. Yet, when yields climb past thresholds and Treasury market liquidity perceptions shift due to reduced foreign demand, pension actuaries adjust return assumptions, including for equities, which often underperform in high-rate environments. Funding improvements from liability reduction are often offset by equity losses, affecting the retirement security of 50 million participants. The fourth channel is the Social Security Trust Fund. The old age, survivors, and disability insurance trust funds collectively hold around $2.7 trillion, all invested in special Treasury issues. Surplus payroll tax revenue is invested in these bonds, while deficits require redemption and new public debt issuance. As Japanese demand declines and Treasury yields rise, interest income on the trust fund's holdings is affected, indirectly influencing Social Security finances. Treasury holdings at lower rates are not growing as fast as the higher yields that would be available if the trust fund's assets were rolling over at current market rates. The trust fund remains locked into below-market returns on existing securities, while the pension obligations it supports must be maintained at the nominal values mandated by law. 36 million Americans currently receiving Social Security retirement benefits, along with 120 million workers whose future payments depend on the trust fund's investment income, are connected to Japanese Treasury selling through its effect on the trust fund's yield environment, a link rarely discussed in Social Security debates. The fifth channel is the 60/40 portfolio destruction pathway. This represents the most direct and immediately visible connection between Japan's Treasury selling and individual retirement account performance. The 60/40 allocation, with 60% stocks and 40% bonds, has been the standard retirement framework since the 1980s, based on the assumption that stocks and bonds move inversely. When equities fall, bonds rise, stabilizing portfolios. This negative correlation held reliably from the 1990s through 2020, as Federal Reserve rate cuts during recessions and crises drove bond prices up, cushioning the 40% bond portion when the 60% stock allocation fell. In 2022 and 2026, that negative correlation is broken. Stocks and bonds are falling together because the Federal Reserve cannot cut rates, while inflation stands at 3.8%. April's Consumer Price Index confirmed that inflation is accelerating rather than declining. The 60/40 portfolio, which lost 13% in 2022, its worst year since 2008, now faces a similar environment in 2026. With April CPI at 3.8%, no rate cuts are possible. The market assigns a 30% probability to rate hikes. Japanese investors sold $29.6 billion of treasuries in the first quarter, and the 30-year treasury reached 5% for the first time since 2007. The bond portion of the 60/40 portfolio no longer provides a cushion, generating losses alongside the equity component. Let us now examine 3 historical moments that illustrate how rising treasury yields, limited central bank flexibility, and simultaneous bond and equity declines can impact retirement portfolios. The first parallel is 2022. That year, the Federal Reserve raised rates from 0 to 4.5% in response to 8% inflation. The typical 60/40 retirement portfolio fell approximately 13%, its worst performance since 2008. Total retirement account balances across 401k, IRA, and pension assets dropped roughly $3 trillion from the 2021 peak. The mechanism was a breakdown of the stock-bond correlation. The 40% bond allocation fell significantly, providing no cushion against equity losses, as rate increases suppressed both equities and bond prices. In 2026, starting rates are far higher than 2022's 0% base. Bonds issued at 4% yields have limited room to fall before reaching institutional floors. Yet, with the 30-year Treasury at 5%, the 10-year at 4.44%, and April CPI at 3.8%, EY projecting 4% in May, risk is pronounced. If Japanese selling accelerates from $29.6 billion in the first quarter to an annualized $100 billion, Treasury auctions will require yields above current levels. Higher yields mean lower bond prices, producing continuing losses in retirement portfolios, even from already elevated yields. The second parallel is the 1994 bond market crisis, the most precise historical analog for the current risk. A well-supported bond market suddenly faced reduced demand, forcing rapid yield adjustments. In February 1994, the Federal Reserve raised rates from 3% after 2 years of accommodative policy. This triggered a global bond sell-off, amplified by hedge funds and leveraged investors with large long-duration positions. As rates rose, those positions unwound quickly, producing one of the most severe modern bond market declines. The S&P 500 fell approximately 9%, and average 30-year mortgage rates rose from 7% to 9.25% by December. Balanced portfolios that had benefited from years of bond appreciation gave back substantial gains in 1 year. While the 1994 scenario differs because rate hikes were the primary driver, the mechanism, falling bond prices reducing total portfolio value, remains identical. Recent retirees withdrawing from accounts during capital losses experienced the most severe stress. The third parallel is Japan in the late 1990s. As stock prices declined from their 1989 peak and real estate collapsed, Japanese pension funds and life insurers with heavy equity exposure faced simultaneous equity losses and bond portfolio pressure due to expanding fiscal deficits. The outcome was a decade-long deterioration in pension finances, prompting repeated public pension reforms and creating enduring demographic and financial pressures. For American retirees, the lesson is not the demographic trajectory, but the simultaneous impairment of both bond and equity components in retirement portfolios, which can cause irreversible damage for those in the withdrawal phase. Retirees must sell assets during downturns, permanently reducing the capital base for future returns. The red alert identifies 4 specific actions. First is the duration assessment. Every portfolio's bond allocation should be tested for sensitivity to a 10-year Treasury yield rise of 50 basis points from 4.44 to 4.94%. TD Economics' projection of 20 to 50 basis points from Japanese tapering provides the scenario range. Second is the money market fund Assessum retirees over 73, who by law must take annual minimum distributions from tax-deferred retirement accounts, face a particularly challenging environment. A simultaneous decline in bond prices and equity values creates the worst-case scenario for mandatory withdrawals, as both components of a 60/40 portfolio are falling at the same time. The fourth action the red alert highlights is the timing of Social Security claiming. The interplay between bond yields, stock valuations, and the sequencing risk of required distributions defines the period when delaying Social Security to maximize guaranteed, inflation-adjusted income becomes most compelling. The Japanese request, please, can you bring this money home, measures the bond market's response in basis points, while retirement portfolios respond in dollars. Translating between the two is the focus of this analysis. Disaggregated data on the $29.6 billion of Japanese Treasury sales in the first quarter of 2026 reveals which investor categories are reducing U.S. Treasury exposure and the acceleration of this reduction. Analysis using Japan. Ministry of Finance flow data shows that monthly selling nearly quadrupled between January and March. The pace was uneven. January reflected modest rebalancing, while March saw rapid acceleration, reflecting developments building across the quarter. Sustained Bank of Japan rate normalization lifted Japanese government bond yields, making domestic bonds competitively attractive compared to U.S. Treasuries on a hedged basis for the first time in 3 decades. Guru Focus Analysis confirmed declines across most investor categories, with particularly sharp reductions among government-related investors, historically the most stable buyers. This category includes Japan's Government Pension Investment Fund, the world's largest pension fund, with approximately $2 trillion in total assets, of which roughly $150 to $200 billion has historically been held in foreign bonds, including U.S. Treasuries. When these conservative, long-horizon, price-insensitive investors reduce U.S. Treasury exposure, it signals a structural, not tactical, allocation change. The Government Pension Investment Fund's allocation decisions are reviewed annually by its investment committee with consultation from the Ministry of Finance and Ministry of Health, Labor, and Welfare. Reductions in target foreign bond allocations become benchmarks for future performance, not temporary adjustments. The acceleration from January to March in this investor category indicates that part of the $29.6 billion quarterly sell-off reflects these structural allocation shifts. TD Economics' March 31st analysis concluded that Japanese investor behavior adjustments are permanent. Even under an orderly transition, reduced Japanese demand shifts more Treasury issuance toward price-sensitive investors, requiring higher yields to clear the market. Price-sensitive investors replacing Japan's stable buyers, such as hedge funds, day traders, and domestic institutions, have fundamentally different time horizons, return needs, and price sensitivity. As these investors become the marginal buyers, yields needed to clear each auction rise. Higher yields increase U.S. government interest payments on outstanding debt, enlarging deficits and prompting more Treasury issuance, which in turn requires higher yields from price-sensitive buyers, a debt spiral mechanism described in Oslo. This shift occurs alongside an April CPI confirming inflation at 3.8%, eliminating Federal Reserve rate cut possibilities, and introducing a 30% market probability of rate hikes. Mark Malik highlighted the anomaly. Since mid-2024, the Fed cut rates by 175 basis points, yet the 10-year yield fell only 35 basis points, while the 30-year reached 5%. This disconnect quantifies the structural demand reduction from Japan and Europe. Monetary policy is pushing rates down, the bond market pushes yields up, and structural demand reduction cannot be reversed by policy. The approximately 73 million Americans at or near retirement, primarily baby boomers with the largest retirement savings pool in U.S. history, are directly impacted. A red alert signals heightened attention and protective action is needed before risk becomes loss. Like aviation and weather alerts, financial red alerts are issued when conditions are verified and accelerating, not after damage occurs. The $29.6 billion in Japanese Treasury selling in Q1, accelerating fourfold, projected to push 10-year yields 20 to 50 basis points higher, combined with 30-year Treasuries at 5% and April CPI at 3.8%, creates simultaneous stress on 60/40 portfolios. Mandatory retirement distributions face sequencing risk under these declining portfolio conditions, warranting the red alert. The message is not that every account will lose a specific amount. It is that the structural withdrawal of demand from the world's most important bond market, at the scale documented in Japanese quarterly data and TD Economics projections, within a constrained monetary policy environment, requires informed, timely attention before consequences become irreversible. Please leave your thoughts about this content in the comments below. Thanks for watching. See you in the next one.